Okay, so today I wanted to walk you through a made up 25 marker, fairly realistic in terms of the kind of things that typically are examined. So the question is, evaluate the macroeconomic effects of higher interest rates in the UK. Yeah. So if you've ever done an interest rate question or a monetary policy question in the past, you'd recognize the fact that on the mark scheme, they always bang on about this thing called the transmission mechanism. The transmission mechanism is just a really, really fancy way of basically talking about what happens to the different components of aggregate demand. Because as hopefully you know, monetary policy affects aggregate demand. It's a demand side policy. So let's whiz through this in terms of constructing like a really detailed plan, what kind of points you could talk about. Bear in mind that there are plenty of points that I'm sure that I will not be mentioning that you could also have included as part of your answer. Nonetheless, I think this approach is fairly holistic and allows us to cover enough depth to get very close to 25 out of 25. Yeah. So let's begin at the beginning. So clearly, interest rate changes are an example of a demand side policy, specifically monetary policy. Silly way of just remembering what monetary policy is think about the word monetary. Do you guys agree the word monetary sounds a lot like money? And where do most people keep their money? Well, they keep their money normally in the bank. Therefore, monetary policy is controlled by whom? The Bank of England. Yeah. So if we rewind to around 2024, the Bank of England started raising interest rates. We'll talk about why later, but for now, that's what we're dealing with. Interest rates are higher. Okay, so I'd start off very briefly. I know that there isn't a requirement for an introduction. I still think it's worth just quickly showing the examiner that you understand what topic this is. So quickly, I define monetary policy. Monetary policy is the manipulation of interest rates and the money supply in order to achieve macroeconomic objectives. Yeah. Now, very importantly, just before I kind of delve into the question, the terminology macroeconomic effects, that is a very broad question. It basically means that you could talk about any of the macroeconomic objectives, economic growth, unemployment, the current account, inflation, and so on and so forth. Okay. So it's really, really useful to understand what the question is actually asking to ensure that you actually give them what it is the question is about. Yeah. Okay. This is what I want us to do. Our first analysis is going to be focused on how raising interest rates can help to reduce inflation. In other words, it could lead to disinflation. So my topic sentence is going to be something along the lines of one likely macroeconomic effect of higher interest rates in the UK is lower inflation or is disinflation. I want the examiner to instantly know that that is going to be my overarching point. Now, it is so important to recognize that in a 25 marker, depth upon depth upon depth is the key to getting top marks. So what I want us to do is to come up with a sequence of questions that you will ask yourself in the exam, and the answer to these questions will basically come together and they will be the basis of your analysis, yeah? So if we go through the components of aggregate demand, so you've got to agree that AD is obviously equal to C plus I plus G plus open brackets X minus M, okay? And what I'm going to do is I want to focus our energy in the first paragraph on these two components, consumption and investment, yeah? And within consumption, you should all know that consumption is the biggest component of AD for the UK. It accounts for about two-thirds, about 66%. Therefore, I want us to give consumption the respect that it deserves. I want us to be able to develop it not one way, not two ways, three ways. There are three questions that I'm going to ask you guys, and the answer to the question will basically come together to form a really cohesive paragraph. Question number one. When interest rates are high, so as it is in our question, are individuals more or less likely to save? So are you more or less likely to put your money in the bank and save? Well, let's work it out. A common misconception is that if I put my money in the bank, it's just like a safety vault and I just walk in and access my money anytime. That is not true. What really happens is that when you are putting money in the bank, let's say HSBC, you are technically lending money to the bank. They go and invest your money and do all sorts with it. And in return, you get an interest rate. Not particularly great, but you get an interest rate, right? Did you know that if every single person tried to withdraw, I think it's £50 from the bank simultaneously, the bank would collapse. They would not be able to honor that. Anyways, in a nutshell, then, to understand savings, I want you to understand that you put money in the bank as a means of saving, and in return, you're getting interest. Okay. If interest rates are high, are you incentivized to save or not save? Well, the answer is that you have more incentive to save because of the fact that you get what's called a higher rate of return. It's a fancy way of saying you get more back on your money. So savings are going to go up. People are going to save more. And if you save more, obviously consumption is going to go down. So that's question number one, tick. Question number two, in terms of the impact on consumption. Well, my question to you guys is, do you know how a credit card works? Some of you might know, some of you might not know. Let's differentiate between a debit card and a credit card because it's important to understand the difference. Let's say that I have £100 on my debit card, yeah, or my bank account, sorry, yeah? I have £100 in my bank account and I use my debit card, let's say, to pay for something that's worth £30. All they do is they take from the £100 that's in my bank account, and I now have £70 in my bank account. That is a debit card. A credit card is not your money. In other words, when you spend money on a credit card, it is not yours. You're essentially borrowing money from the credit card provider, whoever that might be. At the end of the month, you now get a statement which tells you all the things that you just basically purchased that month. For me, delivery. Right, but anyways, so it would be that. And now I have to pay that back plus interest. Okay. So again, to understand, a credit card is a way of basically borrowing money. Now, if interest rates are high, are people going to borrow more money or less money? Well, obviously, they will borrow less money because it's expensive to pay back loans. And therefore, as a result, if they borrow less money, they also spend less. Consumption goes down. So what we write is cost of borrowing, which is a fancy way of saying that the interest that you have to pay back on any loans that you take out has gone up. It's expensive to borrow money, yeah? Therefore, you're less likely to take out loans, less likely to use your credit card, and consumption, therefore, again, goes down, okay? Next. The next thing is to do with mortgages. Now, some of you may know what a mortgage is, some of you may not know. Let me just quickly go through what a mortgage is. So, the way a mortgage works is this. Imagine I find a house available for sale for, let's say, £1 million, yeah? Now, contrary to popular beliefs that are spread on YouTube, I don't have £1 million in my back pocket, not yet. So what I do then is I might save up, let's say, 20% of the value of the asset. I save up £200,000. I then apply for a mortgage on behalf of, through a bank, let's say, yeah? If my mortgage application is accepted, what will now happen is the bank will now go and pay the remaining £800,000 on my behalf. And I now get this thing called a mortgage. It's essentially a piece of paper which says that I promise that I will pay back the bank the £800,000 that I just basically borrowed off them, plus what? Plus interest, right? Mortgages tend to vary from 20 years all the way through to like 35 years, sometimes a bit longer than that. But anyways, the point is that you're going to be paying back significantly more, by the way, than £800,000. So it makes sense for the bank to give you that loan. It also kind of makes sense from your perspective, though, because you can own the asset now. So, for example, if my house increases in value from, let's say, 1 million to 1.2 million, the £200,000, excluding tax, that is all mine. It's not the bank's. Anyways, what is more interesting for us to understand is that there are two broad types of mortgages that you need to know. The first type of mortgage is called a fixed interest mortgage. Not that interesting. A fixed interest mortgage is where you pay the same amount of interest on your mortgage monthly, doesn't really change. So that, not that interesting. The other type of mortgage is far more interesting for us. It is called a variable mortgage, otherwise known as a tracker mortgage. So I'll write down the word tracker here. Right, the word tracker is a pretty good clue. What does it track? Well, those mortgages track the Bank of England interest rate, the Bank of England base rate, basically. So if the Bank of England raise the interest rate, as they are in our question over here, individuals who are on a tracker mortgage are now paying a higher rate of interest per month on their mortgage. Okay, so if that's you, let's say that now you're paying a higher interest on your mortgage. Do you have more or less disposable income left over? Well, obviously you have less disposable income left over. Therefore, consumption, does it go up or go down? Obviously, it goes down. Make sense? So what we write is interest on variable mortgages. Mortgages spelled really weird, by the way. It's got a T for some reason. They go up. It's more expensive, basically. Therefore, consumption goes down because you've got less disposable income left over. Now, notice, by the way, that in that exercise that I took you guys through, consumption went down every single time. If you ask yourself these three questions when it comes to interest rate questions and you're getting different answers for consumption, something has gone wrong. That cannot be the case. They must all be moving in tandem. So just to summarize, you're going to save more because interest rates are higher. You're going to borrow less because interest rates are higher. And people on tracker mortgages will have less money because of the fact that they're having to pay a higher amount of interest on their mortgage. All of these three things led to consumption going down. Cool? Right, let's deal with investment in the same paragraph because I want a lot of depth for the 25 marker. So investment, the way I wanted to remember investment is imagine that a firm has to borrow money from the bank in order to invest. Now, I know that they could probably use their own profits as well, but I'd always want you to remember it as firms borrow money to invest into new capital machinery. Okay, if interest rates are high, are firms going to borrow more money or less money? Well, clearly they're going to borrow less money because it's expensive to pay back any loans that they take out. Therefore, investment is likely to go down. They're also likely to take less risk, by the way. They're likely to become more risk averse because if it doesn't quite work out, the investment, I have to pay back quite a lot of money because the interest rate is high. So the same logic as we had over here where cost of borrowing was high, same thing applies to businesses. And so here investment also goes down. So I just kind of remind them about this again in my chain of reasoning. Yeah. All right. Very clearly, if consumption and investment are both falling, they are both components of aggregate demand, right? And so aggregate demand is likely to shift inwards. You now draw the diagram. So let's quickly draw the diagram, and we can point their attention to a few things on it. So let's do this. Here's real GDP, and here's the price level, which is otherwise known as inflation. Okay, so we're going to draw a Keynesian LRAS curve like this. This one. Okay, so I'm going to have my AD curve somewhere over here to begin with. And all we know, based on what we've said so far, is we're going to get an inward shift of aggregate demand. P1. And here we are, something like this. Yeah, I've probably exaggerated a bit too much, but it's fine. AD2, Y2, P2. Okay, so can you see that this is disinflation? Just to clarify, by the way, the price level, this is a rate. Yeah. So what that means is that sometimes people look at this and go, oh, that's deflation. Well, it depends on what P1 is. Because if P1 is, let's say, 0%, that could be, by the way, it doesn't have to be that. That's not 0%, not necessarily. Then, of course, then that will be deflation. Now, in the UK economy, back when this was happening, inflation rates were actually very high. They were about 8-9%. So this is not deflation. This is disinflation, which is where prices are still rising, but at a slower rate. So let's say hypothetically, if this was 8%, if it now goes down to 6%, that is still a rise in the price level, as in prices are still rising, sorry, but at a slower rate. So anyways, we will now just draw the diagram and summarize it and show that there is clearly disinflation, which helps the Bank of England maybe get closer to the inflation target of 2%. Okay, cool. That is our first analysis, and hopefully there's enough depth there for you guys to write that up in a 25 marker. Let's evaluate it. Right, there are a couple of evaluations. Now, those of you that have seen my video in terms of the impact of quantitative easing or monetary, low interest rates, one of the evaluations there will be like liquidity trap. That does not work here, because if interest rates are going up, the Bank of England, obviously, when they raise interest rates, commercial banks are obviously going to raise their interest rates as well. That doesn't work here. But there are a couple of generic evaluations that you could apply and make really strong. So I'm going to draw you guys a little exercise very quickly. You know what I'll do over here? Let's do then. I'm going to draw, without labeling the equilibriums, two LRAS curves. So let's pretend everything's labeled. So here's an LRAS curve, here's an LRAS curve. And in both scenarios, I'm going to shift AD inwards, yeah? So I'm going to shift AD inwards here. And I'm going to shift AD inwards here. All right, and my question to you is this. Which of these is sensible policy, and which of them is extremely stupid policy? The correct answer is that if your economy is initially at spare capacity, in other words, the economy is doing really badly, the worst thing you can do is raise interest rates. And the reason why is because if I raise interest rates, I'm discouraging people from spending. Consumption goes down, AD shifts inwards, firms make less money, they fire workers. All I get, can you see, is negative economic growth with no change to the inflation rate. So this is ridiculously silly. In contrast, if the economy is at full capacity, it's what we call overheating. There's high levels of inflation because there's too much economic activity going on. So now, can you see that when I reduce or shift AD inwards, nothing happens to growth. But what I get is a lot of, hopefully, disinflation. In other words, this is entirely sensible policy. If you're near full capacity or at full capacity, raising interest rates makes complete sense because you reduce inflation whilst not really impacting economic growth very much, if at all. Whereas on the left-hand side over here, if the economy is struggling to begin with and AD shifts inwards, this is a catastrophe because you just get negative growth, higher unemployment, and nothing has happened to inflation. Right, this is why I think this is a really clever evaluation for this question. You're going to do two things in one. Number one is to have some real-world knowledge, which is when the UK economy was experiencing high levels of inflation, its economic growth was really low. We had practically zero economic growth, like 0%, yeah? In other words, where do you think we were? We probably were operating over here. So you could talk about that. The second thing is what was the cause of the inflation? Now, there are obviously multiple different reasons for inflation occurring, but one of the limitations of the Bank of England is that they do not have any influence over supply-side shocks. And a big reason for why inflation in the UK was high at the time was the Ukraine-Russia war. It led to gas prices rising, and that affected, obviously, the short-run aggregate supply. It affected the cost of production for firms, etc., etc. In other words, 2 points in one. One is that this is not the policy tool to deal with a supply-side shock. And clearly, or maybe it's because of the fact that there's the war in Russia and Ukraine has caused the cost of production to go up, and that's why inflation is high. And the second is the impact on the economy and whether this is likely to actually bring inflation down depends largely on where the economy is to begin with on the LRAS curve. What is the elasticity of the LRAS curve when AD initially intersects it? And realistically, the UK economy was probably at spare capacity. And you can justify why. Explain that economic growth rates were very, very low, very sluggish growth. And therefore, you can even draw this. You can show, much neater than I have, by the way, you can show that, hey, look, you get negative growth or potentially push the economy into a recession, but nothing happens to inflation. This is really bad policy tool. Yeah? That is our first half of the essay. Let's deal with the other half of the essay. So if I go back to aggregate demand, if you notice, we basically spoke about consumption and investment. And then we have the following remaining components. Now, government spending is fiscal policy, so we can ignore that in a monetary policy essay in terms of analysis. Just pretend it's not even there. Now we're dealing with exports minus imports. Now, the current account, exports minus imports, there is a very important concept that I need you guys to understand. And that very important concept is something called hot money. All right, let's make sense of hot money. This is how hot money works. Hot money is investors around the world want to park their money in the bank accounts that give them the best rate of return. In other words, wherever interest rates are higher, I would want to park my money there. I want to put my money there because I get a higher return. So let's assume I'm a multi-millionaire, yeah, and I have loads of money. What I want to do is I want to put it in the bank account that gives me the best interest rates. Now, hot money can either therefore flow into the UK or it can flow out of the UK. Let's work it out. If interest rates in the UK are high, would investors, let's say like in America, in Europe, let's say Switzerland and Italy and whatever, would they want to leave their money in Switzerland and Italy, or would they rather now put their money in the UK? Would you guys agree if interest rates are high in the UK, based on our question, hot money will flow into the UK? People want to park their money in the UK. Okay, so how do they do that? Let's work this out through exchange rates. So let's draw it over here. So in the foreign exchange market, people are buying and selling currency on a minute by minute basis, second by second even, yeah? So we have the quantity of pounds over here, and this is the price of pounds in any other currency. So let's just do dollars, okay? And here is the supply of pounds. Now, very important point of clarification. If you and I were to go to a newsagent and buy something in the UK, that has absolutely no bearing whatsoever on the foreign exchange market. The foreign exchange market is where you are actively buying and selling currencies. So, you know, when you're about to go on holiday, let's say you're about to go to France and you need to get some euros for your holiday. Yeah. Well, in order to do that, what you would be doing, I know people describe it as I would convert my pounds into euros. I know that's technically correct. I don't like that as an explanation, though. The reason why I don't like it as an explanation is because it doesn't paint the full picture. Whenever there's an exchange, there is a buyer and there is a seller. In that example of you going on holiday to France, you would be selling your pounds and buying euros, by the way. Yeah? Right. Anyways, let's go back to this to make sense of this diagram. So we just said that hot money is going to flow into the UK economy. Investors from around the world decide, you know what? It's more attractive to leave my money in British bank accounts because the rate of return is higher. How do they do that? Well, they will be selling their euros. They will be selling their whatever currency, let's say like dollars, and they would be buying pounds. In other words, if there are more buyers of pounds now, do you guys agree that demand for pounds shifts out? Demand does this. There we go. That's D2. And that is the new equilibrium. Okay, right. What happened to the pound? Now, some of you might be saying, oh, it became more expensive. That's correct, by the way. The fancy word that I prefer you to say, though, is the pound has just appreciated. Yeah. And if you got that right, I appreciate you. So the pound has appreciated. Okay, quick tangent, and then I promise we'll come back to this. So the quick tangent is this. When it comes to the current account, I just need you guys to constantly remember two countries. There are two countries in the world that are major exporters, but they are exporters for totally different reasons. The first major exporter in the world, you hopefully know, is China. Right, why do people buy Chinese goods? Well, people buy Chinese goods because they are typically cheaper. In other words, the fancy way of describing that a country is cheaper than others is that they are price competitive. In other words, if you're cheaper than other countries, you are price competitive, okay? The second country is Germany. Think about German brands, Mercedes and Audi and Volkswagen and Adidas. Did you guys know that Adidas was created by two brothers? They had a fight and then one of them created Puma. Adidas one, but still. Puma's not bad. Yeah, anyways, German, right? German, they're not known for cheap though. What are they known for? They are known for being really, really high quality. In other words, the current account and the reason why a country will have a surplus or a deficit really just hinges on two things. You're either more price competitive or you're more quality competitive, or vice versa. Obviously, you might not be price competitive or might not be quality competitive. Okay. Now, the UK economy, we have a current account deficit. We import more than we export. Yeah. And I just said now that the pound has just appreciated. All right. If the pound appreciates, does that make the UK economy more or less internationally price competitive? You might want to pause the video and have a go yourself. The answer is less price competitive. Remember what I said about China? I said that China are attractive in the global market and are more price competitive because their goods are cheap. Well, if the pound appreciates, that means the pound is now expensive for everyone else around the world. If that is the case and we're less price competitive, what does that do? Just scroll down a little bit. What does that do to exports? Well, exports out of the UK, in other words, what we sell to the world now will go down. And a really good question to ask yourself in the exam to give yourself depth, very simply, is to go, why? Well, the why is because other currencies like the US dollar cannot buy as many pounds now. At the same time, imports are likely to go up. Why? Because the pound is now stronger. It can buy more international currency. Therefore, we can buy more imports from around the world. Okay. Now, the combination of exports falling and imports rising. Now, some of you may already know that this worsens the current account deficit. If maths is not your friend, can I just recommend a very quick thing that you could do to just see it? So let's say, I'll make up numbers. I'm going to say exports are equal to, let's say, 400. Okay. And imports, let's say, are equal to 1,000. Okay. To make it so we have a deficit. So x minus 7 to begin with is obviously minus 600. Okay. Look at what we just said. We said exports are going to go down. So let's pick a number below 400. So let's say 300. And imports are going to go up. Yeah. So let's go, I don't know, 1,200. All right. What's x minus m now? Well, x minus m now is minus, my maths is not embarrassingly bad, hopefully, minus 900. Yeah. What happened? The deficit widened. The UK's current account deficit got worse. And by the way, that would be my overarching point in terms of macroeconomic effects is another likely impact of high interest rates is that the UK's current account deficit is likely to worsen. I then walk them through all the chains of reasoning. Hot money will flow in, explain why, shift out the demand curve, explain that the pound is appreciated, less price competitive, exports go down, justify why, imports go up, justify why, and wrap it up by saying this therefore worsens the UK's trade deficit or current account deficit, interchangeable. Yeah? Right, let's evaluate and then we're done. The last thing is the evaluate. Now, whenever it comes to the current account and the impact of exchange rate movements, I want you to always evaluate using Marshall Lerner. And this time, there won't be a J curve, it will be the upside down J curve. Yeah. Just we'll call it the curve. Yeah. Now, if you haven't watched my video explaining the Marshall Lerner condition and J curve, I cannot emphasize enough the importance of doing so. Like, it's such a useful video to get your head around. So I'm going to kind of whiz through this. You guys definitely can watch that video. So we're going to say, look, for whatever we just said to happen in the analysis, in other words, for the current account to worsen, the Marshall Lerner condition must be satisfied. Okay. Now, the Marshall Lerner condition states that the average sum, if you guys don't write the word average, by the way, they're not going to penalize you. They don't normally write the word average in textbooks. Technically, hopefully, I proved it in my previous video, it is the average, but whatever. The sum of the elasticities of imports and exports must be greater than 1. In other words, they have to be elastic. Yeah. Your exports and imports need to be elastic for whatever you just said in the analysis to materialize. Yeah. And the reason why here is because every unit that is exported out of the UK now is more expensive, whilst every unit that in the UK imports, so we import into the UK, is now cheaper. Yeah, you'd basically explain that. And now you're going to draw this as like a partner to it. So we're going to have time. And this is current account. You could write it in full in the exam. Positive, negative. Now the UK obviously has a deficit, so we start somewhere over here. Okay, right. So we just start with nothing happening to begin with, just like that. Yeah? Okay, the way to draw this and the way to work it out is you're going to say to yourself, you're going to go, okay, whatever I said happened in the analysis, the opposite happens first. So in the analysis, we said the current account is going to get worse. True? Well, then the opposite of that is it gets better, and then it eventually will get worse. So it's going to go up and down. Now, I could have done it, by the way, so it could go all the way up into the positive territory. That doesn't make a difference, yeah? It's just the shape. It needs to be that. And that's the exact moment, by the way, the pound appreciated. So that was appreciation of pound. Okay, really quickly, just to emphasize why or explain why that happened. The reason why that happened, by the way, is that British firms are likely to be tied into trade contracts. And therefore, in the short run, exports and imports are likely to be fairly inelastic. So the pound appreciating is going to improve rather than worsen the current account. Again, if this doesn't make sense, honestly, just go watch my video on Marshall Lerner. It will make it really clear to you. Yeah. So that is the evaluation. And that is, by the way, top level evaluation. That is exceptionally high quality. Yeah. And that's it. And then I think in the judgment, just choose, whether you think it's effective or not. I'd probably argue that it's not the most effective policy tool because of the fact that the inflation in the UK was mainly a supply side shock and the economy was already fragile in terms of growth, and therefore raising interest rates probably isn't the best idea at that point in time. Yeah. But anyways, that's hopefully clear. And yeah, I'll see you guys very, very soon.